Thanks for tuning in to our 2015 crop insurance update meeting. My name's Corey. I'm with KW Insurance in Sunburst, Montana, and I'm going to walk you through all the changes that took place with this 2014 Farm Bill going forward. The first big change, as far as the Farm Bill is concerned, is the new disaster program options. So, previously you had Sure and ARC that you could pick between, or Acre, I mean. Now you have 3 program options, which we'll get to later in these slides. They eliminated your direct payments. So, last fall in 2013 was the last direct payment check you guys will get on your farms. There won't be one coming here in 2014 for your base acres. That's one thing a lot of people hadn't realized. It's kind of important to understand because for an average size farm that could have been a $30,000 to $40,000 check possibly. So no more direct payments. There's a beginning farmer program which will now be installed in the crop insurance side of things, which gives you a discount as a beginning farmer on your crop insurance and also some better yields potentially. Their native sod busting rules are much less favorable than they used to be, and now SCO insurance is available through your crop insurance agent, which that's our crop insurance side of the disaster program that you can sign up for. Here's a comparison of the 2 farm bills, as you can see down below here. On the 2008 Farm Bill, 68% was made up of nutrition funding. In this 2014 one, now almost 80% is food stamps, nutrition type programs. So when people say that the Farm Bill that has just been brought forward is almost $1 trillion bill, this is true probably over the next 10 years as far as how it's projected, but most of that is food stamps and nutrition. Only a small fraction here, as you can see, less than 20% actually makes up our farm side of that bill. So big thing that was cut out of there were the commodity programs. That's your direct payments. So you can see the commodity type programs are from 12% of the last Farm Bill down to only 4% on this new one. Beginning Farmer Rancher, BFR, you'll see a lot on here. That's what that acronym stands for. That is the program that they came out with to help beginning farmers with their premium and also weathering some bad years by assigning some better yields than you normally would get. So what does this mean? You could not have had an insurable interest in a farm or ranch for more than 5 years to qualify. You can exclude any year in which you are under the age of 18 or on active duty in the military or gone to college. So there may be some instances where some kids were included in the corporation on the farm, which would actually technically make them an insurable share in that farming operation. If you were under 18, we can exclude those years or in the military, basically. How do you qualify? You need to fill out a BFR app before the sales closing deadline to qualify. So that deadline is September 30th for the winter wheat. If you're seeding winter wheat for those crops, we need to have that app turned in by then to get you the discounts on that. So BFR Benefits, you get an additional 10% premium subsidy. So instead of the government paying roughly 65% of your premium, now they'll be paying 75% or higher if you're in enterprise units. It's easier to transfer yields from the previous producer, and 80% of the T yield is used for the yield substitution for bad years instead of 60 like it would be normally. So on this yield transfer thing, that means you could have been just working for someone doing the labor on the farming operation, and we could transfer the yields over to you if they wanted to roll you into that farming operation now. Native sod breaking. This is breaking out any ground that has never been previously farmed. It's really frowned upon both at the FSA side and in crop insurance. Going forward here, that's one big focus of the Farm Bill is to save this native sod basically. So how do they discourage it on the crop insurance side? They're only going to give you 65% of the county average for the first 4 years after it's broken out. This would apply to any ground that was broke after February 7th, 2014. So if you broke out a bunch of native sod this spring, this will be retroactive back to that land. Or going forward, if you do any native sod breaking, even if it's only 5 acres, you better go into the FSA and tell them what you're doing before you do it and get approval, because it could actually throw you out of all these farm programs on their side as well. So what will happen also is your premium subsidy will be reduced 50 points. On our crop insurance side, that means instead of them paying, let's say 65% of your premium, now you only get 15% subsidy on native sod for 4 years. What does that mean? Had you been paying $10 an acre premium for wheat, let's say on that unit, now all of a sudden it would jump up to $20 an acre for only 65% of the county average for your guarantee. So, and there's no way around insuring this as long as you seed it to an insurable crop. The only way around, I guess, actually paying the premium would be to seed a crop that's not insurable in our county. So really frowned upon. It's going to cost you a fair amount of money to do this, and also your guarantee is not going to be very good for the first 4 years. So if you're going to do a bunch of sod busting, please talk to us and the FSA before you do it. There is an exception for 5 acres or less. If you would just broke out some fence rows or something, that could just get thrown in with the rest of the acres on the unit basically and be insurable without this paperwork. But still, talk to the FSA. So that concludes the first little segment of our program here. The next one will be understanding the disaster programs, the 3 different programs that you can actually enroll in going forward on this farm bill. So that will start the next segment of our video. So, understanding the disaster programs, how does that work? The first thing would be, what the heck are base acres? That's the most important thing to understand on this disaster program setup. Most people don't really understand base acres, really where they came from to start with, and they were set up back in the early 80s, sometime in the 80s anyways, using kind of your average acres that you farmed on each farm number. They would establish your base. So had you done half barley and half wheat on a 1,000-acre farm, you would have ended up with 500 acres of wheat base and 500 acres of barley base. We can actually reallocate those acres by the farm number, but they never increase anymore. So on your 1,000 base acre farm, you could switch your base acres to all wheat if that's all you've done in the last, let's say 5 crop years. They're going to give you a chance to reallocate it, but you can never increase it. It doesn't matter if you seed the whole farm to peas. If your base acres are wheat, you'll be paid off the wheat side of the program. So when we get into these disaster programs going forward, when I'm explaining them here, just understand that it's your base acres that you're going to be paid off of, not what you're seeding in any given year. The other thing that doesn't matter is how many acres you seeded on that farm number. Your payment's based off of those base acres, basically. So you have a one-time chance to change your mix of acres around this fall at the FSA and update your yields. Like we said, the FSA, as you'll see on the next slide, sent you out a letter that shows you what the base acres are in each farm and what your mix of acres was in the previous 5 years from 2012 back. If you'd like to switch your base acres around using that new mix, you have an opportunity to do that going forward here. The other thing is some farmer numbers may not have any base acres left as they have been transferred out when they were in CRP. So if you ended up buying some land that was in CRP, it's possible the base had been transferred somewhere else off of that land, and so you could have a farm number possibly with no base acres. So in other words, that land wouldn't qualify for disaster. Here's a letter that we got from the FSA. You guys all would have received a letter like this probably a little over a month ago. This is being done right now in the middle of September, this presentation, so somewhere at the beginning of August, I think. And it shows by farm number what your base acres are in each farm number, basically, and what the mix would be. So let me grab a highlighter here. You can see on this farm, 2203, we have wheat and barley for base. We have 752 acres of wheat base and 416 acres of barley. The other thing that'll apply going forward, depending on which of these disaster programs you sign up in, is this average yield for your crops on each one of these farms. You can see for this specific farm, it'd be 37 for the wheat and 43 for the barley. So how do you know what you are signed up for basically on your farm or what your mix of acres are? You find this letter that the FSA sent you and reference it basically. More terms of market year average, that's the average price for a crop for an entire crop year basically in the whole nation. So if you average all the wheat in the U.S., that'd be winter wheat, spring wheat, soft white wheat, everything in general, you would take that and average it all into one big pool for, let's say, the 2014 market year, and that's what this MYA would be. That's a term you'll see in all these disaster programs as the market year average. That's not necessarily from December to December. It might be from June to June or July to July, let's say, or whatever. So starting in July of 2014 all the way till July 2015 might be the market year for 2014, when the crop starts growing and when they kind of finish marketing it. So the reference price for this PLC program, that's the price that the market year average needs to fall below before it starts to trigger. So we'll get into that in the next slide. And then the ARC guarantee price. ARC is basically like a giant crop insurance unit for the entire county. And they're going to take their average price and their average yield to come up with a guarantee for the county. If it falls below that level, it'll start to trigger a payment, basically. And so it's like the whole county being harvested for your crop insurance unit. So what do we choose, ARC or PLC? Hopefully after going through these slides, this will help you a little bit determine kind of which way you want to be going. The FSA is also going to put on some trainings here in October, which you probably want to attend to get their take on this as well. But I'll take you through all the research I've done on these programs, which hopefully will help clarify this. So, first one is PLC. That's price loss coverage. The important part of this is to look at where it says price, because that's all that this program cares about. It's national prices on each commodity and whether they fall below a strike price. So it pays when the yearly average price for a commodity falls below a reference price. What are those references, at least for the big commodities in our area? Wheat would be $5.50, barley $4.95, peas $6.60, and canola $10.40. Your payments based off of your FSA yield. So remember on that previous slide, in that letter that we had, I'll go back there. You can see on that letter you got from the FSA, each farm number has its own yield assigned here. That's what this PLC payment's going to be based off of. And then it'll take that FSA yield you had times the amount below the reference price for the current crop year that they came out with times 85% of your base. So here's an example of how PLC works. In our example here, we have farm 123. This is just an example farm number. On this farm, we have 1,000 base acres of wheat, as you can see. Only 85% of those acres are used in any of these programs to make your payment. So you have 850 base acres of wheat that will pay for PLC here in this example. So the next step then would be figure out what your FSA yield is. Just like we looked at in that letter, that last couple slides back that we looked at, the FSA mailed you guys out a letter that shows you each farm number and what your yields are for each top crop type versus the farm number, and also how many base acres you have there. So this 1,000 base acres, that would have come off of that FSA letter, as well as this 40 bushel yield. The reference price for wheat in this PLC program is $5.50 a bushel. So the next step in this program would be to figure what the market year average price for wheat was for the crop year. In our example, we're going to use $4.50. So we're saying for the whole year in 2014 here, we averaged $4.50 a bushel for all types of wheat in the U.S. That's $1 less than what our reference price was. So your payment is triggered because we're below the reference price for the market year, and you're paid on the 40 bushel yield times the dollar that you're deficient, or a $40 an acre payment on the 850 base acres here, which was 85% of your total base acres. So your payment in this scenario would have been the 850 acres payable times the $40 an acre, which was figured from the dollar deficiency below the reference price, gives us a $34,000 payment for this farm. So once again, where do these prices come from in this PLC program? From the farm level, they use your FSA yields, which you got off your letter, and 85% of those base acres on each farm number to figure your payment. They don't use any county level yields or any county level information because the prices are determined nationally. So it doesn't matter how well our county does yield wise or anything. This is only triggered off of price, right? And then on the national level, that payment trigger price stays the same for the whole 5 years of the farm bill. So that $5.50 for the wheat, it's going to be the same for all 5 years. If it gets below these numbers, then that's when it starts to pay. Then the market year average, which we talked about in previous slides, that's the average for the whole crop year for wheat, let's say. That's figured over the whole nation, and that's going to get thrown in here to figure your loss. So once again, the loss formula for PLC, whatever the trigger price is, which in this case is $5.50, minus the market year average price. So if it's below this trigger price, it'll start to pay, times your FSA yield, which goes off of that letter, right? And then times 85% of your base acres for that farm equals your PLC payment. Individual ARC, I'm not going to spend a whole bunch of time on this because I don't foresee really anybody doing it, I guess, but it pays on only 65% of your base acres, so there's your first disadvantage. So your payment automatically is substantially lower than it could be on the countywide ARC just because of that. It uses your actual yields for history and for payout. So it's sort of like having a giant crop insurance unit for the whole farm and a free program for the government here. It still caps out at 10% of the total crop value, so you're still going to be limited probably to around that $20 an acre or whatever for Toole County for wheat. Then it mixes all the commodities in the farm together before figuring a loss payment. So in other words, maybe the wheat did really poorly on your farm, but the barley did average or better. It could pull your wheat out of a loss. So there's multiple ways that you could get less of a payment in this program. The one time this would work better is if just your farm had some serious loss issues. So it requires more record keeping because you're going to have to update your yields every year plus prove your production, but it does reflect more closely as to what happens on your farming operation. Because of the fact that it only pays on 65% of the base acres, and it also combines all the crops together before it pays. From all the research I've done, even from the other ag experts, they figure this one's probably not going to be very popular, at least in our area. So here's how our county ARC program would work. From the farm level, they're going to use your acres, so they're going to take 85% of your base acres, just like in our previous example. So if you had 1,000 base acres of wheat, 85% of that, or 850, would pay. From the county level, they're going to take the 5-year Olympic average yield, and that's for your yield guarantee for the whole county. That's like this entire county of Toole County right here is going to be one giant unit, basically. So they're going to take 5 years of its average wheat yield, throw out the highs and the lows, and come up with the average. This is just like your APH and your crop insurance. And then the average yield for the current crop year for the county to determine your loss payment. Nationally, that's where the pricing part of this comes from. They're going to take the Olympic average price for your base price, or your guarantee, basically. So they're going to take 5 years of the average price of all the wheats thrown together in the nation to come up with a base price for your wheat. And then they'll take just this crop year's average wheat price throughout the nation to determine what happened to the wheat price versus what our base was. So this would be like our harvest price down here, the market year average price. So your formula for your guarantee part of this would be as follows. They take your county Olympic average yield, which they'd get from 5 years of average yields in Toole County, times your national Olympic average price, which is 5 years of the national wheat price averaged out, to give you a county projected revenue here. So for our example, we're going to say you have a 35 bushel yield in Toole County. We had a $6 average price over the last 5 years for wheat, which gave us 35 times 6, or $210 of projected revenue. Or they're estimating that all the acres of wheat in Toole County should average out at $210 an acre. So this would be kind of like your base revenue on the crop insurance side. The most this can ever pay out is 10% of this number. If the price of wheat was to go up, then the projected revenue could go up. But to make this simple, basically this caps out at 10% of this projected revenue number. So as you'll see farther along this example, the most this will pay out is $21 an acre. So as you can see here, we're going to take the projected revenue for the county times 10% is going to be our max payment. So the most we could get in this simplified example anyways is $21 an acre times 85% of those base acres. So here's a loss payment example. So what do they use for your loss? They're still going to use the 85% of your base acres for the farm, obviously to pay you on. For the county level, they're going to use the 5-year Olympic average for your yield guarantee, just like it was in the previous slide. And then the average yield for the current crop year, that is like you reporting your harvested bushels to us on an individual unit on the crop insurance. This is on a county-wide basis. And then nationally, they're going to use the Olympic average price to figure your guarantee to start out with, and then the market year average price is like the harvest price in your crop insurance. So how does it work? Here's the formula. You take the county's projected revenue, which remember was $210, times 86%, because basically they're insuring us at the 86% level for this program, minus the market year average yield, which you'll see up here is, like say the 2014 average yield for wheat in Toole County, times the market year average price. So for 2014, that'd be what wheat averaged for the whole year as well. So you take your projected revenue, which is 210 times 86%, minus whatever the county actually cut for revenue, and that's how they figure your loss payment. So for our example, we had a $210 an acre projected revenue times 86%. That gives us $180 an acre guarantee. This would be just like what your guarantee in the crop insurance would be. And then for our example here, we're going to say in Toole County, we averaged 25 bushels an acre for all the wheat in Toole County for 2014. And then the market year average price in the nation for wheat went down to $5. So they would take the $180.60 we were guaranteed minus the $125 we harvested, and they'd come up with a $55.60 loss. Now remember from our previous slide, this program maxes out at 10% of this projected revenue. So even though we're $55 below our guarantee, the most we'll get paid is $21 an acre. We maxed out this program basically, and we'll get $21 an acre times those base acres, that 850 base acres of wheat that we had. This next slide shows us, and you can actually watch this update every month. If you just look up MYA wheat prices on the internet, it'll bring up this chart that'll give you the running average at the end of every month of where these market year average prices are projected to end up. So first off, you can see where they were at the previous 5 years. This is what they'd use for your Olympic average. And then you can see where it's running at for this year. So if you look at barley for August 12th in 2014, you can see they were projecting barley to come out at $4.75 a bushel. Our PLC base for that's $4.95. So if it stayed there, barley would trigger a payment in PLC for sure. Wheat's at $6.30. There's some other ones that might be of interest to you guys. Canola here, if you have any canola base acres, is only 18 cents a pound. And the PLC trigger, I think, was something like 22 cents. So you can watch this every month anyways, as the statistics service is averaging these commodities out. That's what this chart is showing you. So what is SCO? That's our program that we offer. It's a pay-in type disaster program that we offer through your federal crop. How does it work? First off, they figure whatever your individual coverage level is for a crop on your insurance policy. So if your level was 70%, the SCO is going to cover the difference between the 86% and the 70%. So you'd have 16% of your expected revenue in any given unit basically is going to be covered on a county-wide basis in this SCO program. How does SCO work? Similar to ARC, but it's based off your actual seeded acres, not your base acres. That's a plus for multiple reasons. Oftentimes you guys are seeding way more actual acres of crop than what you have for base acres at the FSA. And also this would be a way to pay into disaster programs for, let's say, like peas that you may not have base acres on now. The only commodities that are eligible so far in 2015 are wheat and barley. They expect quite a few more crops to be added in 2016, but for now it's just wheat and barley. To sign up for this program, you must be in PLC. You can't enroll in ARC. So there's the other stickler on this, is that you can sign up for PLC and be in our program simultaneously, but you cannot be in ARC and then enroll in this federal crop side of this program. So here's an example of how SCO works. You chose a 70% level on your wheat for your federal crop. We add SCO as an option at this time. This would be when you do your sales closing and pick your levels. We can also add the SCO coverage. The SCO then would cover the gap between 86% and the level on your crop insurance. So like we said, if you picked the 70% level, it would give you 16% coverage on the county disaster side. And in your average yield on this crop insurance unit's 40 bushels an acre with a base price of $6. So you out of a total expected revenue for this unit on your policy at $240 an acre. This SCO policy is going to cover 16% of that $240. So if the county, now this is a county-based program, not off of your individual yields, but if the county fell below 70% of its average yield and price, then you would cap this out, or you'd get $38.40 an acre back on all your seeded acres in this unit of wheat. So how's the whole county guarantee fee yield figured? This would be how they're going to trigger your loss payments. It's triggered off a county level, not off your crop insurance individual unit level. So let's say we had a base price for $6 and the county average wheat yields 35. So we'd have a $6 base. It was figured off of the same way that your crop insurance base price is figured. So it's figured off the futures market. And your yield is an average of the last 5 crop years, throwing out the highs and the lows. So in 2014, we'll say the county itself, Toole County, average wheat yield and projected price are figured at $210 an acre. That was the 35 bushels, which is our county average yield for wheat, times the $6 base price. So the county had an expected yield or revenue of $210 an acre. Your SCO payment on your crop insurance side then would get triggered once the county's revenue falls below 86% of the base price. So, or the base revenue. So we had $210 an acre expected revenue up here. They took 86% of that to figure where it's going to start to pay at. So once Toole County's revenue in this example gets below $180 an acre for the whole county for wheat, this would start triggering payments on your seeded acres on the crop insurance policy. So here's how the payment would be figured then. Your county base revenue was set at $210. As you remember, then our guarantee was set at $186 basically. But the harvest price was figured on your crop insurance at $5 for this example, and then the county only averaged 30 bushels. So we ended up with a county revenue of $125 an acre. The county's revenue was 55% of what its average was, or this 125 that we actually harvested for Toole County is only 59% of the $210. So your SCO payment is figured based off 59% using the county yield and price. In this scenario, you had the 70% yield on your crop or level on your crop insurance. You would have maxed out your SCO payment because 59% is below your current crop insurance level. So you'd get the whole amount of your guarantee. What's the advantage of SCO? One of the big ones is it allows you to receive payments through PLC at the FSA and simultaneously receive disaster payments through your multi-peril. So it's kind of like being enrolled in ARC and PLC at the same time. You have 2 ways of getting paid. Possibly 2 could trigger at the same time in any given year. There's no payment cap on SCO, which it's $125,000 per person or legal entity for the FSA programs. And because it's triggered at the county level, you could be eligible for a payment even if you cut above your average crop on your operation. So this could work both ways, obviously. Maybe you had a disaster on your farm, but the county as a whole did well. You might not qualify for an SCO payment. But it also could be that your county had an average or above average year. You didn't qualify for a federal crop payment on your individual units, but this could still trigger a payment on the county-wide level. The other big advantage is that it's based off your actual seeded acres as reported on your crop insurance, not off your base acres. So if you went and seeded 2,000 acres of wheat, let's say some of it was recrop even or whatever on your farming operation, but you only had 1,000 base acres of wheat, you could actually receive a payment on all 2,000 acres of the wheat that you seeded because it's based off your reported crop insurance acres on this program. What are the disadvantages? Obviously, one of the biggest ones is that it costs to participate. So it's going to cost you between 11 and 14% of the guarantee to participate, depending on what level you're at in your crop insurance. For a lot of you guys, the guarantee on this is probably going to be somewhere between 30 and 40 bucks an acre, so it's going to cost you between $3 and $5 an acre, probably. The other disadvantage, which also could be an advantage, as we talked in the previous slide, is that it's based on a county yield and national market year average, not on the actual yields or local markets that your farm is using. So the whole county has to trigger a disaster, not just your farm, which could leave you in a situation where your farm triggers a payment or some of your units on your farm, but this program may not pay. The only other disadvantage is it won't be paid until the market year average price and yield are figured for your county, which will probably be October-ish of the following crop year. So if Toole County totally got wiped out by drought in 2014, let's say, you wouldn't receive your payment until October of 2015 after they got all of the survey data back. So what would we do? In all the scenarios that I've run anyways, it seems like a combination of PLC and SCO will give you the best chance of a big payout. One of the big advantages of this, of course, is that the PLC can pay simultaneously with the SCO. Or if you sign up in their ARC program, you're stuck just in that program for 5 years. We can sign everyone up for SCO that's seeding winter wheat and then roll you out of it here. So that's what we did this fall. If you go to the FSA trainings, which will be happening in the later part of October here, and you decide, well, SCO is really not for me, or I don't want to pay into this, we can opt you out of it. So last couple things we're going to cover in these slides. What was the winter wheat base price for 2015? $6.41 a bushel is where you're going to be set at for your base price for winter wheat right now. Actually a pretty good price considering where the market's at currently anyways. So why would you not want to be in enterprise units if you seed winter wheat, or what's the risk of it anyways? This is really important for everyone to understand. Enterprise units affects winter wheat, spring wheat combinations in a different way than it does a lot of other crops, because it's going to throw the winter and the spring wheat together in one big pot. So in our example here, we have 4 units, each with 50 acres of either spring wheat or winter wheat seeded in them. If you put your farm into enterprise units for that big premium savings, it's going to throw all the wheat on the farm together before this loss is paid. Even if the winter wheat has a loss, so let's say you want to zero the winter wheat out and just take your money on the winter option, you'll have to harvest the spring wheat before any payment will be issued. And it's possible that the spring wheat could do well enough to pull the winter wheat out of a loss. So we just always try and stress this point to people if they're going to do enterprise units in their wheat, especially if they're seeding winter wheat, to understand the fact that it's going to throw the types of wheat together, not just all the spring wheat and all the winter wheat together. It's going to throw all the wheat together, basically. There's a large discount on your premium for this, but there's multiple ways that this could create some frustrations in a loss scenario for you. If you left it in optional units, each unit would pay separate, and the winter and spring wheat units are separate as well. So you might have had this winter wheat unit get wiped out. You could take all your money out of that, settle your claim out in the spring, and then let the rest of this ride till harvest. Where in enterprise units, you couldn't do that. One other thing that's coming up here soon is the PRF deadline. November 15th is the deadline to make changes to that program. It changed from September 30th. I think that might have been a couple years ago now. And please review the acreage reports we send you and let us know if you need to add or delete any fields on that, or if you want to opt out of that program. So it's again, November 15th is the deadline for the rain. This is the rainfall insurance for your pasture and rangeland. If you have claims, even if you think you might have a claim, it's best to turn it in now and sign off on it later. We don't want to turn in just a whole bunch of random claims, obviously, and generate a bunch of paperwork, but if you think there is a realistic chance you might have one, we better get it turned in. You only have 15 days from the time you harvest the unit to turn in a claim, and poor grain quality is used as a factor for paying a loss by reducing your bushels. So in other words, any of your barley that has 10% or more sprout damage in it would be thrown into sample grade. If your barley gets thrown into sample grade, they'll reduce your bushels by 30% right off the bat, plus add the damage on top of it. So it could be that you cut 60 bushel barley, but they're only going to consider it 30 bushel barley for claim purposes on your crop insurance with all these quality factors figured in, which could push you into a pretty good sized loss. So if you guys have quality problems, but you add a bunch of bushels, don't assume that you don't qualify for a crop insurance payment. Because some of those factors may very well push you down to the point where you would. Poor falling numbers is considered in spring wheat. That's the only crop we'd use falling numbers in as far as we're concerned. But if you do have poor falling numbers, that's another thing to consider possibly turning a claim in for. And then mold damage or sprout, which is probably our biggest factor. Protein is not a quality factor. So I wish it was. We know that's a huge discount factor for pricing for you guys, but it's not a quality factor on the crop insurance side. Any of these other things, though, if you have grain that went US number 5 or sample grade, had a bunch of sprout in the barley, please turn claims in because you very well might qualify for one. So we had sent you out quote sheets. I'm not going to review this in this online demonstration, but this does actually show you how much the SCO costs per acre at least. So for the summer, fall, and winter wheat, there's a $17 an acre guarantee, and it costs you $2.40 an acre to be in the SCO. Thanks so much for watching. It's coming, but I guess this is from our meeting. If you guys have any more questions, feel free to call me or anyone here at the office. Our number is 937-6950, or you can go to kwsunburst.com and find all of our information on there as well.